All right, so I want to start with, and feel free, by the way, throughout the day to jump in, stop me, slow me down, question things. So I want to start with giving you guys a sense of what I mean by a real effects perspective to accounting. Let me start as follows. Many times at Chicago, I hear from the finance guys or the economists, what is accounting? What makes accounting a discipline? You probably also face that. You may already be facing it when you tell people, your family or your colleagues and so on. What separates accounting from finance? Is it just we're doing what finance people do and economists do? I think accounting is a very different discipline from finance, and I think it comes to the forefront when you think about actually real effects. So for me, think about accounting is a language. Right? It's a language that is used to communicate with outsiders. It's a uniform language, actually, meaning that regardless of your business model, whether you are a high-tech firm, whether you're oil and gas, whether you are a retail, a merchandising company, you use the same language to communicate to outsiders, to recognize revenues, to report your R&D. Regardless how innovative you are, you still expense your R&D. Why is that? Why do we have a uniform language? Also, accounting is about measuring and disclosing things uniformly in a certain way. So some things we never measure in accounting, right? We know that. If you take the standalone books of a company, there's no asset called human capital. But an economist would tell you that human capital is one of the most important economic assets, but it's not an accounting asset in the sense that it's not on the balance sheet. Why is that? Right? Why do we expense R&D? Why do we have brand names not measured and disclosed unless there's an acquisition, we know? Then you recognize brands, right, in a purchase price allocation. So, in other words, accountants measure and disclose things in a very particular way. And why is that? Why do we do that? If you think of traditional research in accounting, we cannot answer these questions. Most of the time we'll say, oh, because if it's value relevant, maybe we should disclose it. But we're not really going after the trade-off that I think many standard setters are thinking about, which is, well, to measure an asset, to recognize an asset, it has to be relevant and it has to be sufficiently reliable. Then you measure it. How do you make these trade-offs? Can we come up with a model that captures essentially what standard setters are thinking about? Only recognize an asset as long as it's sufficiently relevant and it can be measured reliably, right? Or disclosure, right? Why do we disclose in a certain way? We disclose, coarsely. We disclose not too frequently. What are the trade-offs in doing all that, right? So in other words, that's how I view accounting. It's a language to communicate with outsiders. That language is very rich because it captures a lot of business models, but at the same time, we make compromises in that language. Why do we make these compromises? Not recognize certain things, not disclose certain things, but disclose in a very particular way. Okay? So I'll try to today give you guys a sense of answer some of these questions, or at least get us to think about models that could go after these issues, right? So my introduction here would essentially motivate that, and then I'll go to specific models. So some of these models I'll talk about today are from papers that are published. So I would mention the papers, but I would encourage you to look at the papers. Of course, it's not that we're meeting again tomorrow, but after I've covered these models, then I'll tell you, go and look at those papers. I think it's better that you see me present those models and then you can go and dig deeper into these papers. The papers are probably much more, richer in terms of their modeling and more things, but I want to give you a sense of the general theme of some of these papers. We'll get into details in these models. I think I'm being very ambitious because I have 5 papers that I plan on covering, but each paper could take 2 hours. But we don't have 10 hours, I already know today. But we'll see. We'll see what happens as we go along, all right? So here's the outline from what I want to discuss before I get to the board. What do I mean by real effects? Jeremy gave you a flavor of it by saying it's a feedback effect. I view it more as a feedback, as you'll see. It's above and beyond a feedback effect that work is done in finance and economics. I'll talk about some studies on disclosure and transparency and relate that to real effects. And then I'll show you a very simple model that shows you how you can generate real effects. And I'll talk about a couple of real effects studies here, but mostly on the board later on, and give you some insights. What are the insights from these models that we won't get if we ignored real effects? Right? What is it that we learn from these models when you incorporate real effects that if you ignored it, you would lose these insights? And in my mind, that's what's most important for us to think about. And then I'll maybe talk a bit about empirical research as we go along throughout the day. All right? So what do I mean by real effects? What we measure, what we disclose, how we measure, how we disclose would affect decisions firms are making. Right? The real decisions of the firm. Investment, production, right? R&D, the type of decisions that they're making. That's what I mean by real effects. Meaning that we're going inside the firm and seeing how their behavior is changing. Right? And how disclosure or measurement changes behavior. Right? Essentially, that's what I mean by real effects. I'm just not looking at price effects then, right? We are looking at how firms' decisions are changing. In fact, one way to think about this, and that will be the theme throughout today, there's a two-way relationship between firms and financial markets, right? What we know a lot about is going from how decisions are mapped into prices. If you think of the work in finance, a lot of it is pricing, essentially, these fundamentals, right? Agents in the market are pricing fundamentals. So that's the arrow going from left to right. But the focus today would be to look at both of these simultaneously. Decisions affect prices, prices affect decisions. Or one way to think about it is anticipation of prices is going to change the very way I make my decisions. Right? That's what I mean by essentially looking at the real effects. So we'll be studying these two simultaneously. Another way of thinking about it is, this is actually a slide I have when I teach to my MBA students. Most of it, even if you read the accounting standards, they think of accounting as a mapping from economic reality into financial statements and disclosures. Right? And here's the accounting lens, as I call it, which is the accounting standards, the measurement process. Right? They're mapping from reality to statements and disclosures, and then this information in turn is used by outsiders. But you can see here very well that the economic reality, the fundamentals are taken as exogenous, as given. And then in fact, if you read the standards also, many of them talk about that, right? You know, we're measuring these, future cash flows of the firm, but the cash flow typically is taken as given, right? And you measure it in a certain way. So in other words, accounting reflects economic reality, right? Accounting reflects economic reality. So I think that's one side of the coin. In my mind, what I want to show you today actually is that accounting not only reflects economic reality, but it changes economic reality, right? It changes economic reality, and therefore, if you want to go after these basic fundamental questions, you have to essentially look at how economic reality changes, right? So the way to think about it, and some of these models would essentially capture this today, you'll have the real sector. These are your firms and banks, your technologies. You have the information sector, which is your financial statements, the information from the firm. And then you have the financial sector. We're going to study the interaction among these three sectors, right? Their interaction. So we know a lot. I mean, there's a lot of work that goes from disclosure to the market, right? A lot of work on voluntary disclosure, if you think about it in accounting, is you have information from the firm disclosing to, right? You have information disclosed from firms, and then in turn this information is priced, right? So these two arrows we've studied a lot, right? Disclosure from firms, voluntary or mandatory, and then how this is priced, right? Through supply and demand of securities. But to see how this accounting is changing economic reality, we need to close the loop, which is that anticipation of price changes is going to affect fundamentals. Anticipation of price changes. The way that's going to be, you're going to be priced in the market is going to affect your decisions. Okay? And therefore, as a result of that, to study the desirability of disclosure, transparency, or measurement, you have to essentially model how the firm's decision itself is going to change in light of the measurement process changing. Right? In fact, if you talk to most CFOs or insiders of firms, most of them are worried about how their decisions, given an accounting mandate, their decision is going to change. It's like, you know what, we may change the way we do things because the market is not really understanding, right? They tend to say that. They're not really understanding what we are doing. Because of this disclosure now, we may have to change the way we do things. They're talking about real effects. They're talking about real effects. And then the question is, how does, essentially these disclosure, these measurement rules change the firm's decision, right? Typically in accounting, the conventional research and disclosure, there are a few I'll mention here, essentially studies that ignore these real effects. For example, association-based studies, they just look at, so these are theoretical studies mostly, they look at disclosure, how it affects equilibrium market prices, right? And what they do is the market traders are assessing the firm's future cash flows or liquidating dividends, and essentially look at effect of disclosure on equilibrium prices and trading volume. That's very common. Those are called association-based studies, right? To disclose how does that affect behavior, and typically in the market you may have informed, uninformed traders, right? That's quite popular. And then you'll talk about, oh, you know what, volume will change this way, prices will change that way, and so on and so forth as a result of disclosure. Or discretionary-based studies, again, many of them are theoretical work. They look at firms' incentive to voluntarily disclose or withhold information. Right? This starts with, you've probably seen this, the work of Roverecchia in '83, then Rondai, and then until today, you see a lot of work on voluntary disclosure, right? The friction keeps changing, but typically you'll see this. Again, what's missing here is the firm, right? The firm is there making a disclosure, but the firm's decisions are not modeled in light of this disclosure. And efficiency-based studies also, here you set up an information system ex ante. Should you or should you not disclose information? And there typically the goal of disclosure is, mandatory disclosure is to look at the impact of disclosure on the firm's cost of capital, right? So the cost of capital is as close as you get to the firm, but the firm itself is not again model, right? I'm not criticizing these studies. We've learned a lot from these studies. All I'm saying here is we need to go beyond that, right? And I'll argue that we need to go beyond that to be able to go after some of the fundamental questions that we accountants face. Right? We accountants face, right? The standard setters face. We need to go beyond that and go after these type of studies. Again, all these studies are conducted in the context of pure exchange economies, in the sense that firms are not model. The firms is a black box. Given these assumptions, typically then the conclusion tends to be that, oh, more transparency is always good. More disclosure is good. Barring what? What's the cost of disclosure for 99% of accountants? If you ask them, it would be what? Proprietary cost, right? Everyone will tell you that it's proprietary cost. Proprietary cost is the reason that firms are not disclosing, right? That's the most compelling argument an accountant would make. And 99% of them. It's proprietary cost. That's why firms are not disclosing. So higher transparency is always good. It improves market discipline, so goes to say. That's why market discipline improves price efficiency, which is captured by the firm's cost of capital. Right? Bid-ask spread is lower, that's good somehow. There's less disclosure, there's more information in the market. Therefore, the cost and benefits of increasing transparency is higher price efficiency against proprietary cost. So voila, right? Proprietary cost. Then you go and look after measures of proprietary cost, and then you somehow show, of course you're always able to show if you look enough, you will be able to show that, voila, here's proprietary cost, and for these type of firms, you'll tend to see there's less disclosure. Right? Again, there are problems with these type of studies, maybe because some of these firms, it's not that they're not disclosing enough because of proprietary costs, maybe because the type of information they have is very soft, that cannot be credibly disclosed. Right? So you have to be very, very careful in these empirical studies, but typically that's essentially the goal of most studies in accounting, right? 9.9 out of 10 is more transparency is good because it improves price efficiency, reduces bid-ask spread, but there are proprietary costs. Now from a social welfare perspective, do we care about proprietary cost? It's not clear. In fact, no studies have shown this, empirical studies have shown that what happens to social welfare, most of it is looking at each firm in isolation. If you're talking about mandatory disclosure, at least analytically, theoretically, and empirically, you need to make an argument that your disclosure is going to affect, it's going to hurt you. It might benefit other firms. You have to look at the size of the pie. But we don't see that, right? Empirical work is not going after social welfare when they're looking at proprietary cost. Right? They're looking at individual firms. So I see from a voluntary disclosure perspective, perhaps proprietary cost might be an important cost. But when you're talking about disclosure, mandatory disclosure, it's unclear to me proprietary cost is an important cost. Even if it is, then we need to show it empirically, right? We don't know it. I'm not aware of it. Maybe you are. There are very few papers. I'm not even aware of one. If you know, let me know. That's going after social welfare or measuring the impact of disclosure on one firm voluntarily or mandatory on the other firms and measuring that. Right? We hear about it, right? There is some attempt at measuring it, but we don't see it, right? So what's missing from this conventional view, again, in my mind, is the following. We need to model the firm. So the way we're going to do that today is I'm going to model firm. Firms are run by insiders that face market pressure, right? I face market pressure. Now, what do I mean by market pressure? Meaning that they're going to care about the way they're going to be perceived in the market, perhaps via prices of their securities. Such market pressure, then, I will show you, induce these insiders to essentially respond to changes in the disclosure environment. Do we believe that, do insiders face market pressure? In my opinion, yes, because many times you talk to them, they feel like, oh, we are making this disclosure, the way we're going to be priced in the market might change the way we do things, right? So that's what I mean by market pressure here, the way that your securities are going to be priced. Then the question is if how accountants measure and disclose your economic transactions changes these transactions. So disclosure and measurement changes these very transactions you're trying to measure. Then evaluating the desirability of transparency, we need to go after these real effects, measure them, quantify them. So empirically, we need to quantify them also. Right? Now that's challenging. Granted, it's easy for me as a theorist to say that because in my model, I can show you the change. But that's the opportunity for empirical work, right? To essentially go and look at how decisions are changing. Now, how do you do that? Probably you can't use your typical archival type of studies to do that. They don't lend themselves to this. This is where you need to be more creative with your empirical work, right? Probably use things like field experiments. That's an example, right? Even surveys in my mind, even though they have their problems, to go after how, essentially disclosure or measuring things in a certain way changes decisions. You cannot go after essentially large-scale empirical or capital market studies the way they are conducted, right? So, all right, so given that, I'm going to talk about two sufficient conditions for the presence of real effect. Sufficient. And I'll use that throughout the day in those models, right? The first one is the friction I'm going to focus on, because I feel that's one important friction. The friction yesterday was moral hazard. The friction I'm going to focus on today is insiders know more than outsiders. You believe that's an important friction? Do you believe that insiders of firm know more than the outsiders? Or do you feel that the market has all the information?
The market aggregate may have.
In the aggregate, the market may know more than the firm. Okay, maybe. But do you believe that when I make a decision, I know more the reason I made the decision, I have that information. Eventually the information might come out, I'm not saying that. But at the time you're making a decision, corporate managers are more informed than the market about profitability, about the information environment. Okay? That's the first assumption I'm going to make. Now we can disagree with it, but that's okay. If there's insiders and outsiders have the same information, then you could argue that why do we need disclosure? Why do we need to measure things? They already know it, right? They already know it. Now, there might be other reasons that you may want to still disclose, but at least from the perspective of the market already has the information, why do we need to disclose and measure it in a certain way? So that's the first friction, information asymmetry between insiders and outsiders. The second assumption I'm going to make is, I call it impatient shareholders. Another way to think about it is that the rewards to outsiders of a firm doesn't depend on terminal cash flows. It depends on the movement of prices or the path of prices of the firm in the economy, right? So in other words, your rewards to owning a firm, shares in a firm, doesn't depend on accumulation of terminal cash flows. Again, I feel that's a very important assumption, but realistic in the sense that most of us invest in firms, we're not waiting for terminal payoff, right? We essentially invest in a firm and we care about the performance of the prices, the share prices of the firm, right? Either in the short run or in the long run. By the end of the day, we care about price movements, not about terminal cash flows, right? Not about terminal cash flows. That's assumption number 2, right? I call that impatient shareholders. Now, I'll talk about this assumption later on, but these two assumptions taken together means that I will show you that disclosure measurement will have real effects. Will have real effects, yeah.
So when you say impatient shareholder, does that include also managers? Because I also see papers where maybe like the manager is less impatient than shareholder as well.
Yeah, it could also be managers. It could be managers are being compensated based on the share price of the firm. And if they're compensated on share price a year from now, 2 years from now, that's what I mean by impatient. So it could be any stakeholders of the firm. What matters is that you don't care about terminal cash flows, right? So you guys can see where I'm going with this. I'm trying to essentially capture environments in which you don't care about terminal cash flows. You care about how you're perceived in the market. And how you're perceived in the market means that you have to care about how prices are formed. Prices will depend on beliefs about future cash flows, and these beliefs about future cash flows will depend on information that the market has, how things are measured. Yeah?
So you've emphasized since the beginning that these real effects go through prices.
Yeah.
This assumption that you think that they will be valid for publicly traded firms, but we might have reason to believe that there might be real effects, like, type firms. Like
Absolutely. So really, remember, these are sufficient conditions, not necessary. So there are many other conditions. Private firms may also, the real effects could operate through contracts, right? Has nothing to do with disclosure to the market. I write a contract with you, and I'm going to compensate you as an insider based on essentially beliefs about future cash flows. It doesn't have to operate through prices per se. But any time you're trying to measure future cash flows, but either through a compensation contract or through market prices or derivative markets, this is when it's going to kick in. Right? So there are many ways it operates. My focus today would typically be, you're right, on publicly traded firms. Because again, I feel that disclosure, what makes this uniform language called accounting important is you're disclosing to the mass, to the market. Right? You're not disclosing to very sophisticated traders per se. You're disclosing to the mass. And then you're using that information to price the firm. Right? You're using that information to price the firm. In fact, in my mind, that's why we need a language. Because if we're communicating with a broad audience, you need a language, because all of us have to understand it. But if you're disclosing essentially to a small subset of sophisticated investors, you may not need a uniform language. It's easier to communicate with them directly, right? So the larger the set of investors that are small, the more that it is that you need a language, right? Because you want to compare firms. By the way, that's a topic that is very interesting. I'm not going to talk about why do we need a language, but think about it. We don't have any theoretical work, as far as I know, about why we need firms to disclose using that specific language. What are the trade-offs? There are trade-offs, right? There are trade-offs. And I'll talk about it as we go along today, but my focus mostly would be on these real effects. Yeah.
So the first condition seems like a necessary one. The second condition doesn't seem like it's, I know that you're saying that there are sufficient conditions, but it seems like the second one is not necessary, just to kind of think about the framework.
Yeah, well, I view this as sufficient conditions because you could generate real effects in other ways. That's all I mean by this, right? The reason I'm making these two assumptions because I feel they're very natural when I think about firms. Information asymmetry, they know more at least when they're making a decision. Eventually the market might end up knowing more than the firm, or knowing the information may eventually come out. Second, the market is always forming beliefs about future cash flows. And the way I'm going to capture that is, therefore, the shareholders or the insiders of the firm care about market prices. Right? That's all I'm doing here. There are other ways you could capture this. Right? Other ways you could capture this. All right, so here's a model. Here's a very simple model that we'll use actually throughout the day that would essentially capture this idea of how accounting has real effects. A very basic model. Date 0, think of this as an initial date. A firm and a manager of a firm is making a decision. I'm going to call that decision, you get choosing a decision from the set D, big D. You're choosing a decision, small d. And that decision is going to generate future cash flows at dates 1, 2, and 3. I'm going to call that x1, x2, x3. They're random variables at date 0 because they're going to be realized in the future, right? That's why I have the tildes on the x1, x2, x3. I'm going to call y sub 0 superscript f, or y subscript 0 superscript f as the information set of the firm's manager at date 0. Right? So subscript is for time, and superscript is whose information is it. Later on, we'll get into details. We'll put more color on what are these information sets. For now, it's generic. It's a very generic model. And let's call the information sets of the market Y1, Y0 M, Y1 M, Y2 M. This is information sets of the firm shareholders at dates 0, 1, and 2, respectively. Right? Also, I'm going to make an assumption on the information set of the market. It's getting finer and finer over time. Right? Therefore, captured by the following relationship. Right? In other words, over time, more information is coming out, which seems realistic. You could also make another assumption. That's a different kind of model, that over time the market is forgetting. Right? But here the market is getting more and more information over time. Why is that? Through disclosure. They're learning. Right? So Y0 M is a subset of Y1 M, which in turn is a subset of Y2 M. Okay? Now, here's a benchmark. In fact, we'll use this benchmark throughout today. Suppose the shareholders or the insiders of the firm only cared about terminal cash flows from a decision. Suppose they only cared about terminal cash flows. Then what would they maximize? They will choose a decision to maximize the expectation of the terminal cash flows, which is E of x1 plus x2 plus 3, given the information at date 0. Remember, they're making this decision at date 0, so I'm conditioning this. I'm forming beliefs given my information set at date 0 of the manager. Right? So that's a standard, simple, if you will want to call it Robinson Crusoe kind of economy, where you invest today and then you care about your rewards in the future, and then at that time you consume it. Right? That's essentially a benchmark, an important benchmark to study. What decision should I make today to maximize the size of the pie, so to speak? Right? The expected size of the pie. And now, in fact, given this objective function, given the manager is better informed than the market, and the market manager is benevolent, benevolent here is maximizing the size of the pie. There are no agency conflicts between the manager and essentially the shareholders. Here you're maximizing, you're making the best decision you can to maximize the expected size of the pie, which is the expected cash flows. Well, in this kind of world, delegation of decision to the manager will result in first best decisions. Meaning that, what is a first best decision? Decision that maximizes the expected size of the pie of the firm. Right? Again, that's a benchmark. No trade-off here, nothing. The manager has the information, and they're doing the right thing. They're maximizing the expected value of the size of the pie of the firm. Delegate the decisions to them. Right? Nothing more going on here. In that kind of a world, there's no demand for disclosure, and therefore accounting. I only have one firm. There's no demand for disclosure, no demand for accounting, because essentially you're maximizing terminal cash flows, and you have all the information. We'll let you make the decision. Right? We'll let you make the decision. So very, very stylized economy here. Now I'm going to assume, bring in the first assumption I talked about, the first sufficient condition. Shareholders are impatient, which is that they maximize, essentially, they don't care about terminal cash flows. They care about price formation, which is prices at date 1 of the firm and prices at date 2. Now, they care about prices at date 1 with the weight alpha. Alpha is a weight, lies between 0 and 1. And with weight 1 minus alpha, they care about prices at date 2. Now, what is this objective function capturing? Well, perhaps they are liquidating at date 1 with probability alpha. Therefore, they'll consume P1. Or they're liquidating at date 2 with probability 1 minus alpha. They'll consume P2. That's what this could be capturing, this objective function. Or you can think of this as the manager's compensation. is tied to prices, and he or she is going to have shares vesting in the firm with probability alpha 1 year from now, and probability 1 minus alpha 2 years from now. That's another way of motivating this, right? I'm completely agnostic. I'm just taking this objective function as given, right? All I care about here is that they don't care about terminal cash flows, they care about price formation, prices. And that's why this is the objective function. Of course, so therefore manager then is maximizing this given his or her information set, choosing D. Yeah?
Can you explain why P1 and P2 condition in the expectation they condition on information that is not available to the shareholder at date 0?
This is the manager's expectation. So the manager knows this at date 0, right?
Yes.
The market doesn't know this. This is the manager's information, not the market's information, right? But you're right, the market's information is here. So what is P1? P1 is the price of the firm at date 1, which is X1 is realized at date 1. They observe it, so it's X1. Plus, the market is forming beliefs about future cash flows given the market's information, right?
The market's future.
No, the market's current information. This is date 1 price, and this is Y1M is the market's information at date 1. Okay? So this is the market's price at date 1. They are forming beliefs. Again, it's risk-neutral pricing. I'm not discounting for risk aversion. So I'm assuming here shareholders are risk-neutral. So prices is just X1 plus beliefs about future cash flows given the market's information at date 1. I'm not conditioning on Y2 because that's future information. This is date 1 information. Similarly, P2, at date 2, they observe X1 plus X2, plus they form beliefs about future cash flows given information at date 2. Now, I could write here Y1M comma Y2M, but of course, we know that Y1M is a subset of Y2M. Already subsumes it, right? So this is P2. This is P1. At date 0, the manager is essentially taking these prices as given. So this is where essentially what I was talking about earlier. You anticipate the way you're going to be priced at date 1 and date 2. At date 0, these prices are random variables. Why? Because X1 and X2 have not been realized. So that's why I have P1 tilde here and P2 tilde. So the manager is forming beliefs about this, P1 and P2, given her information set at date 0. Okay? So that's essentially the problem. Now, what happens here if we substitute for P1 and P2 in this objective function? Here's the first assumption I'm going to make. Suppose initially, everything the manager knows at date 0 is also known to the capital market at date 1. Right? So this is getting to your point earlier that eventually the market knows everything. At date 1, date 2, the market has the information the manager had at date 0. How? Perhaps via disclosure. In your financial statements, you disclose all the information. Therefore, the information of the market, the manager eventually becomes public. That's captured by Y0F is a strict subset of Y1M. The market might know more. Not just does it know the manager's information at date 0, they may have more information. So that's the first assumption I'm going to make. Right? Now, given this assumption, what I'm going to do is substitute for P1 in the objective function of the manager and calculate E of P1 given the manager's information set. So it's E of P1 given Y0F. It's E of X1 given Y0F. Then the first expectation here, the outer expectation is that of the manager. The inner expectation is that of the market. And that's why the conditioning is inner one is information set of the market, outer one is that of the manager. Now, what is this expression? Well, lower iterated expectation would tell us that the second term would essentially collapse to expectation of X2 plus X3 given Y0F, right? Which means that I can write this expression as follows. What is the lower iterated expectation? It says that if information is gradually getting finer, then the ex ante expectation of future cash flows is going to collapse to the ex ante expectation, right? That's a very famous result in statistics, right? The low iterated expectation. As long as Y1M is finer than Y0F, you essentially get this result. E of P1 given Y0F is E of X1 plus X2 plus X3 given Y0F. Similarly, E of P2 given Y0F, I can write this, substitute for P2 in the manager's objective function. Again, I exploit the law of iterated expectation. The expectation of the expectation, this collapses to E of X1 plus X2 plus X3 given Y0F. which means what? E of P2 given Y naught F equals E of P1 given Y naught F, which means that the manager's objective function, E of alpha P1 plus 1 minus alpha P2 given Y naught F is E of x1 plus x2 plus x3 given Y naught F for all D, for all alpha. That's a benchmark. That's a benchmark result. Now, this result should not surprise you. The reason this is happening is because who cares about what weight you put on prices? Well, who cares about what alpha is? As long as prices are forward-looking and is impounding all the information of the market, maximizing prices is the same as maximizing future cash flows. Right? You hear about that all the time when you first encountered why we should use markets. The power of markets is just by maximizing any point at point time, you maximize price at any point in time, you're incorporating future cash flows. That's the power of prices. But that works only as long as there is no information asymmetry between the manager and the market, because the assumption here was that Y naught F is a subset of Y1M. So as long as the market gets all the information of the manager, there's no information asymmetry. When a firm is being priced, any weight you put on prices doesn't matter. It's as if you're maximizing expectation of terminal cash flows. Right? That's a benchmark result. But it's a very important and powerful result because it's telling us that there's no information asymmetry. Myopia doesn't matter. Myopia doesn't matter. By myopia, I mean that regardless if the manager cares only about date one price, even if alpha is 1, doesn't matter. Prices are forward-looking, manager will take a forward. When you make a decision, you essentially would maximize price as if you were maximizing terminal cash flows. Right? As if you're maximizing terminal cash flows. But that's a benchmark. Problem is, so again, first best decision are attained without the need for any disclosure. Impatience doesn't matter. By impatience here means what alpha is doesn't matter. Right? What alpha is doesn't matter. But of course, now let me bring in the most important assumption. The market may not have the information of the firm at date 1. In other words, the manager has relevant information that is not possessed by the market. So that's the assumption, the sufficient condition 1 I talked about a few slides earlier. Right? Even at date 1, so even at date 1, the market doesn't have the information the manager had at date 0. Now, why is that? We'll go to specific settings after this, and I'll show you why that might be the case. It could be that it's soft information that cannot be credibly disclosed. That's the reason. Right? And we know that's very much the case many times when you have information about profitability, information about intangibles. Very hard to credibly communicate to the market. And as a result of that, even though you have financial statements that are trying to measure these, some of this information doesn't get to the market. Right? So this assumption, in my mind, when it's essentially met, meaning that the managers are more than the market, what are the consequences? What are the consequences? The law of iterated expectation fails. In other words, maximizing the weight on prices is no longer this objective function is not equal to E of x1 plus x2 plus x3. Now, essentially, the weight you put on P1 and the weight you put on P2 matters. Impatience matters. Alpha matters now, right? More importantly, I will show you today the decision chosen by the manager now depends on the interaction between what the manager knows and what the markets can infer from accounting measurements and disclosure. So the interaction between Y naught F and Y1M and Y2M will matter, right? That interaction now matters. Because why the interaction matters? Because you essentially forming expectation, the manager's forming expectation with respect to her information, which is Y naught F, the market's information is Y1M, Y2M. So understanding that interaction and how accounting measurements, accounting standard changes that interaction is important to understand why accounting generates real effects, right? In general, I will show you the manager's decision will not attain first best. There'll be distortions now. Again, by first best means that the D star you're going to choose will no longer be the one maximizing the expected size of the pie, E of x1 plus x2 plus x3. In fact, if the market's information set at dates 1 and date 2 depends at least on what is measured and disclosed to potential stakeholders, then accounting will have real effects. So that's how accounting will have real effects, because now disclosure and measurement will affect Y1M, Y2M. And of course, will affect then the interaction between Y1 and Y2M with Y naught F. which in turn will change D in that model. So that's how, in that sense, measurement and disclosure will have essentially real effects. Okay, this is a very generic model. You may be sitting there saying, yeah, but we need more color. Give us a specific issue. I'll get there. I was just whetting your appetite, right? Giving you a sense of what's coming. The moral of the story here so far is that as long as you have information asymmetry between insiders and outsiders when a firm is being priced, and the outsiders care about beliefs about future cash flows, then measurement and disclosure will change firms' ex-ante decisions, right? That's essentially what came out of this simple, very simple model, right? However, despite the model being very simple, I'm now going to show you some insights that will generate from this model that essentially, in my mind, are extremely important. Okay, let me take a question first. Yeah, go ahead.
So, looking at this, it kind of gets intuitive that the closer one end is to OF, the closer to the first test we're going to get.
Yeah, yeah.
So that would mean that more information is better.
Well,
In a very general terms. So you had the discussion at the
not true. Yeah. It seems that way, right? So it's a very good point. You are Mario, Français. So Mario is raising a very interesting point. He's saying that, well, just looking at the model I put up there, it seems like the closer, he said, Y1M, Y2M is to Y0 F, then the distortion would be lower, right? And then he said, well, that may be, make sort of contradict what I mentioned earlier, or what probably Jeremy mentioned himself earlier when he introduced me, that greater transparency is not necessarily desirable. So let me come to that point, and I'll show you, in fact, that's not the case, right? It depends on the environment. It seems that way, but it won't be the case, right? Let's get there, but thank you for that. So the first insight I want to talk about is, from these real effect studies, is the following. And this will become very clear very shortly. Price efficiency, what does that mean? How well prices reflect fundamentals, is not the same as economic efficiency. What is economic efficiency? Choosing a decision that maximizes the size of the pie. Welfare, if you want. Right? In my generic model, maximizing E1 plus E2 plus E3. So price efficiency is not the same as economic efficiency. Right? Price efficiency are attained if prices are consistent with the firm's fundamentals. In fact, I'll show you, very shortly, I'll show you a very stark model by Jeremy Stein, who's an economist. It's a very simple model written in the late 80s, that prices are fully efficient, but decisions are distorted. Right? The reason I mention this is because many times as accountants, we essentially say, oh, prices are efficient. We're going after price efficiency, and we're using that to make an argument about desirability of disclosure, transparency, and so on. But that's completely wrong, right? In the sense that we cannot stop there. Price efficiency doesn't mean that the firm is choosing the right decision. That's what this is saying here. It's just one side of the coin. The glass is still half full. You have to still continue, right? I will show you this model of Stein where he shows you that firms are taking decisions that are crap, right? They should not be making these decisions, but prices are fully efficient, right? And many times in accounting, you would see people say, oh, the desirability of this disclosure or this standard is to make prices efficient, or prices have become more efficient, or there's more information in the market, that's great. That doesn't take us very far, right? Again, it's unclear that we should be using price efficiency as a gauge to evaluate desirability of disclosure or desirability of measuring something. So price efficiency is not the same as economic efficiency. Sometimes it is, sometimes it's not. Again, I'll show you that. What is important for you guys to keep in mind is, as you change disclosure and measurement, fundamentals will change. But these prices would still reflect the fundamentals at all points in time. Right? So prices are always efficient with respect to the fundamentals. But are you choosing the right decisions is what we care about in these real effect studies. Okay, that's the point. Prices are going to be efficient with respect to the fundamentals. Of course, I'm assuming here that there are no behavioral biases. Right? Agents are essentially fully understanding the consequences. So all my models today would be fully rational. You could always argue, right, that, oh, but agents are stupid. They can't understand disclosure. That's true. But that's a different kind of model. I can't say much about that, right? But in my models, agents are fully rational. The friction is going to be there's information imperfection. That's something to keep in mind, right? Because I just taught in London, Jeremy, with Dick Thaler, right? And he gave, I don't know, you guys read his interview in the FT. He had lunch with the FT. Did you guys see that article? You should look at the article. He said that if you want people to get things done, make things simple and easy, right? Because people are fundamentally stupid. So therefore, to get things done, you need to make sure, right? That's his point. He has some merit in this argument, right? What he's saying. So when I was telling him I'm working on models like this, he's like, oh my God, these models don't exist. But I told him this is a benchmark. The benchmark I have is that people fully understand, on average, they are rational. It's just that there are information imperfection. Let's see what happens. On top of that, of course, he will bring in his behavioral biases and people being unable to process information, right? So I'm essentially sweeping all that under the rug. My assumptions here is agents are rational. There's information asymmetry, imperfect information in the market, right? So prices are efficient. Price efficiency is satisfied. Economic efficiency is not. So I'll show you that model that I'll mention very shortly. The second point I want to make is in accounting, we hear a lot about this measure of accounting quality that many empiricists go after. There's a survey in the Journal of Accounting and Economics, 2010. Essentially, these authors equate higher earnings quality with providing more decision-relevant information on future cash flows. That's their definition of accounting quality. And then here are their proxies. Greater earnings persistence, abnormal accruals, lower quality, timely loss recognition, higher quality, higher contemporaneous associations of earnings with stock return, higher quality, lower probability of earnings restatements, higher quality. Where do these come from? I don't know. This seems very attractive, right? You look at them, they seem very attractive. Oh, greater persistence means that it must be higher quality. But the persistence could be crap. Right? We know firms can essentially be managing their earnings and producing a smooth path of earnings. That doesn't say anything about the earnings quality per se. Right? But again, I'm not criticizing here. All I'm saying here is that there is here no attempt at looking at accounting quality affecting firms' decisions. Right? Which is that our firms, can we come up with proxies for accounting quality that maps into firms' decisions? Right? That would be essentially our firms taking decisions that maximize economic efficiency. All that is missing here, right? Maybe because it's difficult to come up with these proxies. So in that sense, I'm not criticizing. But again, we know that these all have problems, right? What is missing here is the emphasis seems to be entirely on external uses of information, and also you're assuming that fundamentals are exogenous, right? In a real effects perspective, we know that information sustains valuation, valuation sustains corporate decisions, the two-way link, right? So to come up with a measure of accounting quality, we need to be going after measurements that sustain valuation that results in more efficient corporate decisions, right? More efficient corporate decisions. Again, I'll attempt today to show you some of these proxies in some of these models, right? I'll attempt to show you that into how you can come up with a measure of quality. The third insight, so the first insight again is price efficiency is not the same as economic efficiency. Second, the measure of accounting quality ignores firms' decisions in these many times. The third one is related to perhaps Mario's point earlier. Total information in the capital market is a deceptive metric to measure desirability of disclosure. I will show you that it is the channel through which information is communicated, not total information, that is important. Right? Again, through the insights from these real effect studies. I will show you that information, for example, communicated through cash flows, many times reduces economic efficiency. Information communicated through earnings enhances economic efficiency. You may say, how? Well, intuitively, cash flows is essentially taking inflows of cash, subtracting outflows from investments. If these are commingled, it's going to detract or reduce economic efficiency. In fact, that's why we have accrual accounting. Accrual accounting is going to measure these investments. They will do so with noise. But in measuring these investments, you are able to essentially enhance economic efficiency and induce the managers to take a forward-looking view. And I will show you that the power of earnings is it improves economic efficiency, but earnings has its own problems. because it can be manipulated. Again, going after real effect studies, you can look at how decisions change when you outsiders price cash flows versus pricing earnings. Right? An empirical study would tell you it doesn't matter, disclose both, because more information is always better. Right? A real effect study would say, no, be careful. It's the channel of disclosure is going to matter, because some performance measures, some metrics may actually reduce economic efficiency. Right? Yeah, Mario.
So are the results related to the fact that it changes the information set, the size of the information set, or because you're talking about a channel, which is a different concept?
Yeah, this is still your same question. I'll come to that. I'll make it precise. Right? I'll make it precise. It's going to be through both, actually. Right? I'll show you. Yeah.
Give an example of one of these metrics that could, where more information is disclosed, could be harmful.
Let me get to a precise paper, and I think we'll be done better there. Okay, but I'll get there. Yeah. Okay. But you're right. I'll come to these. Right here, I'm just motivating it more generally. Right. All right. Again, I'll skip this. And finally, so this is made directly related to your point. More information is not necessarily desirable. So here I'm going to make it very generic. Then I'll go to a specific example. So here is the insight from a real effect study. Suppose there are two value-relevant variables. I'm going to call this here X and Y. By value-relevant means that it's important for pricing a firm. Right? So the price of the firm would reflect X, Y. Okay? And they're both known to the firm's insiders. So think of X now, okay, to make it a bit more precise. Let's say that X is information about profitability of a project. And let's say that Y is information about the project itself here to take. They're both value relevant. Knowing both of these, the type of project and the profitability of the project is important to value a firm. However, suppose it is difficult or infeasible to credibly communicate X to the capital market, the information about profitability, because it's soft. Even if an auditor goes in there, he or she or the audit firm cannot credibly tell the market that this project is profitable. It's soft information, right? Cannot be audited, cannot be verified. But the project choice, you can say that the firm is working on this type of project. That can be audited and verified and credibly disclosed. Okay, and I'll give you other examples later on. So Y can be credibly disclosed, X cannot be credibly disclosed. Now, given that X cannot be disclosed, is it socially desirable to measure and disclose Y as precisely as possible? Now, in a pure exchange economy, if you ignore real effects, the answer is always yes. Because if you cannot disclose X, disclose Y, because prices will reflect Y, prices will be more efficient. Because at least it's reflecting Y, cannot reflect X. So disclose Y as precisely as you can. However, from a real effects study, I will show you later on, the answer is not necessarily yes. If you cannot credibly disclose X, don't disclose Y too precisely. Why? Here's the general insight behind, intuition behind it. Then the prices will become very sensitive to Y, but not to X. So the decisions could change in such a way that you'll choose the decisions that makes the prices very sensitive to Y, because you know that the market can price Y, not X. And that decision that is very sensitive to Y, but not to X, Y, may not maximize economic efficiency. Right? That's the broad insight. Right? In other words, now you're saying that, oh, you know what? The market is pricing me this way very well. Let me make that decision that essentially allows the market to price me as efficiently as possible. But is that the right decision to maximize the size of the pie of the firm? No, not necessarily. Not necessarily. Right? Not necessarily. And essentially that's the insight from, in other words, then it might be feasible to actually suppress information. Not because of agency conflicts. It has nothing to do with agency conflicts here. It's because the market, you essentially are maximizing price. Price is only reflecting Y, not X, Y. Therefore, to maximize price with respect to Y, you will choose the decision that makes you look better in the eyes of the market. Right? Vis-a-vis Y, not vis-a-vis X, Y. And that decision might not be actually be economically efficient. What you should do is actually perhaps suppress information about Y. The paper I have in mind are one, I don't know if I have time to discuss it today, because that's the end of today, unless we continue into dinner, is a paper on frequency of financial reporting. So I have a paper on frequency of financial reporting. It goes as follows. You again have, so that's the example I have at X and Y. A firm can take work on two types of projects. One project is innovative. The other project is a routine project. Now, for the innovative project and the routine project, you can see the performance of each project, the cash flows from the projects. Problem is you don't understand the profitability of the projects. You also don't understand what the projects are. All you see are the returns from the projects. Okay, so that essentially my X and Y are profitability of the project and the nature of the project. Is this project innovative or routine? Right? Now, one way to do this is you say, should we increase the frequency of reporting? By increasing the frequency of reporting, you may alleviate this information asymmetry about profitability. Right? You get more information about the performance of a project, but that ought to be good, given that you cannot credibly disclose the project type. In that paper, we show actually that once you do that, you increase the frequency of financial reporting, suddenly now you end up choosing the project that essentially is myopic or routine, not innovative, because you become very sensitive to the short-term returns. Why? Because the innovative projects have very good returns in the long run. In the short run, you don't look very good. That's what innovation is, right? A lot of investment, performance in the short run is not very high, performance in the long run is high. So if I report frequently, suddenly now I say, well, the market is pricing us much more frequently. Let's take the project that makes that look good in the eyes of the market, right? Which means makes us sensitive to short-term returns, and that's the routine project. That's, in my mind, is a fundamental problem that outsiders face, right? Think of an innovative firm. Many of them will tell you that our objective is not to meet analyst forecast. Our objective is to work on a project that essentially is very innovative. The problem is with analyst forecast, with quarterly reporting, with this frequent reporting, we end up becoming myopic in the sense that we're working on a project that makes us look good in the eyes of the market. We meet the analyst forecast, we look good, but that project does not maximize the value of the firm. Right? Doesn't maximize economic efficiency. It maximizes price efficiency because you're very sensitive. Prices are reflecting these fundamentals in the short run. And that's essentially an example of essentially suppressing information or having less frequent disclosure may help in that regard because it allows you to essentially work on these projects that are longer term and have higher economic efficiency.
But the statement that more transparency is not necessarily good. To some extent, this problem is caused by the non-transparency of the X value. Still, more transparency is good because more transparency.
No, you're absolutely right. If you could disclose X and Y, you're exactly right. Of course, if you could credibly disclose X, Y, problem goes away, right? By more transparency is not good is the fact that there are some aspect of the firm's information that cannot be credibly disclosed, but you can disclose some as aspect of the information. In that world, you should not be forcing more disclosure because you may be interacting with the information other information that cannot be disclosed.
So these are like your R&D investments.
You cannot credibly disclose R&D investments, but you could disclose maybe the returns from the investment. That's an example of that. Yeah. All right, so that's a long introduction. Now I'm going to use the board. Okay, so how many boards do I have? 1, 2, 3, 4. Okay, so let me start with the first model that I will build on. So all these models will build on each other. So the first model I want to start with is that model by Jeremy Stein. I believe that's 1989. And the paper is Efficient Capital Markets in Efficient Firms. A model of corporate myopic behavior. Okay, I think I need another marker here. Do you have some black markers, please? Ah. By the way, I can give you copies of my notes after I'm done today, okay? So don't worry too much about taking, but it's good you take notes, but my handwriting is pretty bad. But I think together with yours, you'll understand what I've written here once I give it to you.
So we plan to typeset it.
Oh, you plan to...
We'll have it typesetted in latex.
Oh, okay, very good. I need copies of those too, by the way. So the title of the paper is very, very telling here, which relates to what I was saying earlier. I'm going to show you a model where capital markets are efficient, but firms are inefficient. So this is the discussion of price efficiency doesn't amount to economic efficiency. So prices are efficient, but decisions are inefficient. So price efficiency is not the same as economic efficiency, right? And a model of corporate myopic behavior, right? So this paper, essentially, the way to think of this paper, it's a very old paper now, but I think it still has an important insight to it, which is the idea that in the 80s, there was a big discussion or debate about, by Michael Jensen. This is the Jensen and Meckling guy, the half of it. Michael Jensen saying that, oh, the problem with firms is, with CEOs, is they're being compensated based on accounting numbers. Accounting numbers are crap. They're backward looking. We should incentivize managers based on market prices, share prices, because that would allow them to take a forward-looking view. Then they'll make the right decisions to maximize value for the firm. Therefore, prices is what compensation should be based on stock prices, not accounting numbers. Right? Which seems very attractive, right? You think about it, you say, yeah, accounting numbers tend to be backward-looking because they essentially, to some extent, capture realized earnings. So Stein came out and said, no, that's wrong. What you're saying is completely wrong. It has nothing to do with prices per se. Essentially, so he wrote this model and he said, the friction is not, the reason that managers might be myopic is not necessarily the fact that they're compensated on these accounting numbers. It's more about there's information asymmetry between insiders and outsiders. And even if you compensate them based on prices, their decisions will be efficient with respect to prices. Prices will be efficient, but decision will be distorted. So price efficiency is not the same as economic efficiency, which is what Jensen was trying to say, that once you have price efficiency, price reflecting fundamentals, decisions will be forward-looking. Managers will take the right decision to maximize future cash flows, right? So that's the spirit of this model. You can read the model afterwards. I'll show you essentially a simple version of that model, which captures the essence of Stein's argument. So I'll show you a two-period model. Most of my models will be 2 periods today. The simple reason is because the firm will be making a decision. We want the firm to be somehow priced. That would be date 1. And then we want the terminal return from these projects to be realized at date 2. So we don't need more than 2 periods. So we'll keep it simple. Essentially what we want is at date 0, there is some private information between insiders and outsiders. At date 1, not all that information is disclosed to the market. We'll see what happens depending on the question we're going after. And then terminal cash flows or terminal return are realized at date 2, right? So in the Stein model, the firm has assets in place that generates cash flows at date 1 and date 2. Let's call this pi 1 tilde and pi 2 tilde. So pi 1 tilde and pi 2 tilde are returns generated by assets in place. Right? These assets have been acquired in the past, they're returning cash flows. So that's not a decision. So the only decision in the Stein model is the following. At date 0 or shortly before date 1, but I call it at date 0, the manager chooses B, decision B, at a cost of C of B. B is any decision. In Stein's world, actually, it's borrowing. The insider's borrowing at a cost of C of B. So B for borrowing. You can think of B as bias also, you'll see in a second here. But you're going to buy, it's going to work a similar way. But think of it as borrowing. And the cost of borrowing is C of B. And what B is going to do is it's going to affect your return at date 1 if you choose B. It's going to basically change the return at date 1 from pi 1 to x1. So x1 is pi 1 plus B. So by choosing B at date 0, decision borrowing, it's going to boost your short-term return from pi 1 to x1. x1 is pi 1 plus B. Right? And that's it. No impact on long-term return. Pi 2 is the same. In that sense, B is a myopic decision, if you will. Just boost your short-term return. Has no impact on your long-term return. Right? Pi 2 is the same. The cost of choosing, however, choosing B is costly. The cost is C of B. Okay? So that's one aspect of the model. Now, covariance between pi 1 tilde and pi 2 tilde. Let's call that, I call it here rho. And that's strictly positive. So there's some persistence to these returns from the assets in place. The higher pi 1 is, the higher pi 2 is. Yeah?
So only pi 1 tilde and pi 2 tilde are the random variables, right? X1 is not a random variable.
Well, x1 will become a random variable because of pi 1. Right? But you're right. Yeah. B is just an action. Right? B is an action. Whether or not it's observable, we'll see in a second. It's going to be unobservable, you'll see. But B is an action, chosen at date 0. Pi 1 tilde, pi 2 tilde are returned in the future. And x1 is, you boost pi 1 to x1 via the choice of B. Right? And the cost of it is C of B. Choosing this action, C of B. And there's a persistence to these returns from the assets in place. That's rho. Rho is positive. So higher value of pi 1 will imply that pi 2 is likely to be high. Nothing will change in the model if rho is negative, but then it's a bit maybe not realistic, because you could argue that high pi 1, low pi 1 will imply high pi 2. But generally speaking, there's a persistence to cash flows, which seems very realistic. High pi 1 today will imply high pi 2, and high pi 1 implies high pi 2. Okay? Now, what is the manager's objective function? Or what is the objective function here? So max by choice of B. Remember, the only decision in this world is choosing B. You're going to maximize essentially E of x1 tilde, which is cash flows return at date 1, plus alpha E of P. I call that P1 or PP, plus 1 minus alpha E of pi 2. Right? Minus C of B. Right? So that's the objective function in Stein. The idea is you're going to maximize the return from at date 1, which is E of x1. We know x1 is pi 1 plus B. Plus you're going to put weight alpha on the price of the firm at date 1, which call that P. And then weight 1 minus alpha on future cash flows, E of pi 2. Now, what is P? P is firm's market price at date 1. Right? P is the firm's market price at date 1. And shareholders here would be risk neutral, just like it was in my generic model. Risk aversion is not important here in this model, right? P is just the firm's market price at date 1. What is alpha? Alpha is a weight between 0 and 1. Could be 0, could be 1, but in between. Right? Alpha, again, is very similar to my generic model, whereby it captures, if you will, you can call it various things. Could be shareholder impatience. You could argue that shareholders liquidate with probability alpha at date 1 and consume P. 1 minus alpha, they consume pi 2. You could argue that the manager's compensation is tied to the returns at date 1, which is the price at date 1, and the return at date 2. various interpretations of this, right? I'm agnostic about this. All I care about here is that there is market pressure. You can also, Stein also argues that maybe there's a takeover, you care about being taken over, therefore you want to maximize price. Because the lower your price, you know, if the market views that you're undervalued, you could be taken over. You don't like that, therefore you're maximizing expectation of price. Okay? So that's the objective function of the firm. Now, what is essentially in this model B? Well, B is very special in this case of Stein. B is a wasteful action. It boosts short-term cash flows. But reduces economic efficiency. It's a negative NPV project, think of it that way. In other words, he assumes that B minus C of B is strictly less than 0 for all B greater than 0. It's wasteful action. It's negative NPV. Any B that you choose is going to reduce the net present value of the firm. Right? So you should not undertake, you should never undertake B. Question is, of course, will you do it? And he shows you might, right? You might. But this is essentially, and he motivates this in various ways. So far, I'm also taking B as given. He talks about B is very costly borrowing to boost your, you know, make you look good in the eyes of the market by boosting short-term cash flows. By that, it's essentially boosting pi 1 to x1. But overall, it reduces economic efficiency because it reduces the expected cash flows from the firm. So you should not undertake B. Right? You should not undertake B. Now, also, he assumes, so Stein assumes B is unobservable. So that's the key assumption. So you're biasing, you're taking an action that is not observed by the market, and it makes you look good in the short run, but this, you know, doesn't maximize the expected cash flows of the firm, right? Reduces economic efficiency. I will also, you know, after this model, I will show you models where I'll put some life to B, where B would be intangible investments, right? You can view B in many ways here. Here's very generic. Any decisions that you're taking that may make you look good. So you can think actually B as the opposite. You could say it's R&D. Cutting back on R&D makes you look good in the short run, but reduces the value of the firm overall, right? That's like the opposite of B, right? You should, you know, so you can think of B as in many ways here, but let's think of it here as any wasteful action that you're taking that you should not be taking. So if B is unobservable, should it be undertaken? So first thing I'll do is, let's look at a benchmark. So the benchmark is B is observable, just like we did earlier. B is observable. Right? If B is observable, what is the price of the firm at date 1? It's P of expectation of future cash flows. So E of pi 2, given whatever the market observes at date 1. Right? Whatever the market observes at date 1, which is going to be x1 comma B. B is observable and the market observes x1 at date 1. Remember, x1 is pi 1 plus B. So their market is going to form beliefs about pi 2 given x1 comma B. Well, what is this? This is just E of pi 2 given pi 1. Right? Because the market can calculate pi 1 from x1 and B. You just take x1 minus B. You get pi 1. So I can write this expectation as E of pi 2 given pi 1, which means that the objective function then becomes max by choice of B, E of pi 1 tilde plus B plus alpha of expectation of pi 2 given pi 1 plus 1 minus alpha E of pi 2 minus C of B. Right? All I've done here is in the objective function, I've replaced P with E of pi 2 given pi 1. Right? And of course, it's expectation of P, so it's expectation of E of pi 2 given pi 1 plus 1 minus alpha E of pi 2 minus C of B. And you can immediately see from here that this is the same as maximizing by choice of B, E of pi 1 plus E of pi 2 plus B minus C of B. And we know from here that, so this is the expected returns from the assets in place. This is the net expected return from the action B. All right, B minus C of B, and we know what the optimal solution to this should be. Right? In this world, let's call it B full information. This should be 0 for all alpha. Right? In fact, alpha vanished because there is full information, therefore we use the law of iterated expectation. Therefore, E of pi 2 given pi 1 is just E of pi 2, which means that the alpha essentially did not matter. Right? So we're back to the generic model, if you will, earlier, in the sense that maximize any weight you put on prices here doesn't matter. Because there's full information in this economy, the market perfectly backs out the B to calculate pi 1, which is what they care about, to form beliefs about pi 2. Therefore, maximizing this objective function boils down to maximizing terminal cash flows from the assets in place and from the action B. Of course, the action B is negative NPV by assumption. It's wasteful. Therefore, it should never be taken. Again, I didn't have to write all this. This was obvious in the beginning, but I just want to show you the math here, right? The math. Now, how does the math break down once B is unobservable is what I want to focus on. Right? Yeah?
So, right under where you wrote B is, okay, so this is, B is observable.
Yeah, B is observable here. Right? That's a benchmark. B is observable. That's why it's in the information set of the market. That's where I exploited this. So when the market is calculated beliefs about future cash flows, the market observes X1, of course, comma B, right? Comma B. X1 is always observable because that's the return at date 1. It's just that on top of that now, as a benchmark, B is observable, right? Of course, what happens when B is not observable is where we want to go. And again, so I'm going to do it right. Okay, this is not a board, right, Jeremy? Is it? It is a board? Oh, that's very cool. We have 6 boards. You sure? This is not a board. This is our board also? I'll leave my permanent mark here if I do this. No, but this.
No, that's not good. This one is.
Okay, thank you. All right, so B is unobservable. So now what happens? Now let's think about this. B is an action. B is unobservable. Now the market, of course, is rational. The market knows that you would be choosing B. Just that they don't observe it anymore. So what can the market do? Well, remember, B is not a random variable. It's an action. It's an endogenous action. It's an action. It's endogenous. It's been chosen. So we cannot really here say, oh, we're going to basically use some distribution on B, because B is not a random variable, right? The first thing that comes to mind is, oh, we should take a distribution on B, but B is an action. Now, if the market is rational, the first thing that will come to mind is the market might say, well, we will conjecture or we'll anticipate the B that you're going to choose. Huh? So anytime you solve a model where an action is not observable and the market is rational, the first thing you would say is, well, at least the market understands the game that is being played by the manager. Or the market understands the strategy of the manager. Therefore, the first thing you'll say is, let the market try to conjecture B. Of course, we then have to show that the market is indeed able to make that conjecture. So first you make a conjecture, then you verify that indeed the market conjecture is going to be correct. So that's the kind of equilibrium I'm going to solve here, right? And we'll do that a few times today. So the first thing I'll do is, B is unobservable. Let's assume market conjectures B to be, say, B hat. We need to verify that the market is indeed able to do so, right? That the market conjecture will be correct in equilibrium. What does that mean in words? In English, it means that the B hat has to be in equilibrium equal to the actual choice of B by the insider, by the manager. And I'll show you, we'll verify that, right? If we can't verify that, then this is not going to be in equilibrium. We have to be able to verify that, right? Okay, so suppose the market doesn't observe B, say, oh, I understand the game being played by the manager. I'm going to conjecture the manager is going to choose a B hat. That's a fixed number, right? It's a B hat. Now, given the market's conjecture, so given market's conjecture, the market views x1 to be distributed as pi 1 tilde plus b hat. Do you agree? Because that, given the conjecture, now the market says x1 is pi 1 plus b hat. Not the actual true b, the b hat, the conjecture. That's the random, that's how market views x1 to be. A random variable given by pi 1 tilde plus b hat. Of course, the market is going to now essentially using x1, then the market will price the firm. So then P would be E of pi 2 given x1 comma b hat, the market's conjecture. Right? Now you may say, oh, it looks very similar so far. Yeah, it does. The instruction is very similar, but remember there's a big difference here. This b hat is going to be a market's conjecture, not going to be the choice of B chosen by the firm. Right? In equilibrium it will be, but at least when the firm is priced, this is how the firm is going to be priced. E of pi 2 given x1 comma b hat. Now I'll push this a bit further, then I'll go over there. Let me actually use this board here. Then at date 0, the manager is going to take the firm's price as given, so it's going to maximize E of x1 tilde plus alpha E of, now instead of P, I'm going to replace it with E of pi 2 given x1 comma b hat given the choice of B plus 1 minus alpha E of pi 2 minus C of B. Right? You're taking the pricing rule as given in the market, which captures the market's conjecture. Now at date 0, however, the manager is choosing a B, and therefore I'm conditioning on the B that the manager is choosing. I could have done the same thing here, by the way, would have amounted to the same thing. I could have just replaced this here by E of pi 2 given x1 comma B, condition on B. But I didn't do it here, immediately invoke this. Now this is not going to collapse to E of pi 2 given B. The law of iterated expectation fails here because the market's information is not the same, is not finer than that of the manager at date 0. Because this is B hat, this is B. Right? In other words, the market now doesn't have the same information. The market is just forming a conjecture. Right? So I cannot here directly write this as E of pi 2 given x1 comma B hat as given B as E of pi 2 given B. If I did, you can see that I recover essentially the same objective function as here. Right? Because here B is observable. The fact that B is not observable, it has the market's conjecture here. The price in the market is going to depend on the market's conjecture. Of course, it's not going to coincide with the firm's true choice of B. No. So what are the implications of this? We know that the law of iterated expectations will fail, which means that B will now be distorted compared to first best, not be 0. How and why, first of all? But to understand this, let's evaluate this object here, E of pi 2 given x1 comma b hat. Right? We know that, now I need to form the conditional expectation of this. I should have written this up front, but I'm going to exploit normality here to get a linear solution. So I'm going to assume, this is an assumption of Stein also, pi 1 tilde, pi 2 tilde is distributed bivariate normal with mean of E of pi 1, E of pi 2, and variance covariance of sigma squared, rho, and rho. So they have a bivariate normal distribution with the following mean and the following variance covariance matrix. So the variance of pi 1 and pi 2 is, well, why am I using x here? Sorry, let's use sigma squared. Sorry, sigma squared. The variance of pi 1 and pi 2 is sigma squared, and the covariance is rho. So they have the same variance, and pi 1 and pi 2, and then the mean could be different, doesn't matter. You have pi 1, you have pi 2, right? So it's a bivariate normal distribution. The reason he makes this assumption is because it allows me to evaluate this conditional expectation, write it in a linear form. So this is what? E of pi 2 plus covariance of pi 2 with x1 over variance of x1 times x1 minus E of x1 tilde. This is just the projection theorem for normally distributed random variables, right? This is the conditional mean. Let me actually write this because we'll use this result today. I'm going to write it here. So this is conditioning on multivariate random variables. So let me actually write it this way. So x1 tilde is distributed multivariate normal, while x1 comma x2 has a distributed multivariate normal with mean. So let's say this is an m by 1 vector, this is an n by 1 vector. They don't have to be the same size. So the mean of x1 is mu1, that's a vector, and the mean of x2 is mu2. This is sigma 1, 1, this is sigma 2, 2, and this is sigma 1, 2, this is sigma 2, 1. Right, so this is the essentially x1 and x2 have a multivariate normal distribution. The mean of x1 is mu1, it's a vector, m by 1 vector. The mean of x2 is an n by 1 vector. And the variance covariance matrix is given as follows. This is the variance covariance of x1, variance covariance of x2, and this is the covariance matrix. Right? Now given this, here's the general result. What is the expectation of x1 given x2? It's just mu1 plus sigma 1, 2, sigma 2, 2 inverse times x2 minus mu2. Right? That's the general result for the mean, posterior mean. And the posterior variance, we won't use it today. Maybe, I don't remember. This would just be sigma 1, 1 minus sigma 1, 2, sigma 2, 2 inverse, sigma 2, 1. You guys must have seen this, right? In your stats class or somewhere. So essentially, I'm using the top result here. x1 and x2 are jointly normal or multivariate normal here, more general. Then what is the mean of x1 given x2? It's the unconditional mean of x1 plus the variance covariance matrix between x1 and x2 times the inverse of the current variance covariance matrix of x2 times x2 minus the mean of mu2. Sorry, times x2 minus the mean of x2, which is mu2. So I'm using that here. Here, given that pi 1, pi 2 are bivariate normal, and given that x1 is pi 1 plus b hat, if pi 1 is normally distributed, b hat is just a number, x1 is normally distributed, so E of pi 2 given x1 can be written as, use that formula over there, the unconditional mean of pi 2 plus the covariance between pi 2 and x1 over the variance of x1 times x1 minus E of x1, which can be simplified as E of pi 2 plus, what is the covariance between pi 2 and x1? Rho. Variance of x1 is sigma squared times x1 minus E of x1. Now E of x1 is E of pi 1 plus b hat. Right? Because this is essentially the market's beliefs about x1, which is E of pi 1, and then plus the b hat. Right? Minus? Minus. Thank you. Right, so I'm subtracting, the mean of x1. Right, so that's essentially the market's calculation of E of pi 2 given x1. Now, I can substitute this in here. So So substitute for E of pi 2 given x1 comma b hat in objective function to get max of b, E of pi 1 tilde plus b plus alpha times alpha rho sigma squared E of pi 1 plus b plus other terms minus C of b plus other terms that I'm going to skip here that do not depend on b. They're constants. Right, so I've just substituted this expression here over here. And then I'm essentially just focusing on some of the first few terms and only focusing on terms that depend on b. There are other terms here you can fill out that do not depend on b. They depend on the conjecture or they depend on E of pi 2. Okay, now the key thing to note here is suddenly now there's an added benefit to b. And it's being multiplied by alpha rho over sigma squared. That's the b right here. Right? In other words, the first order condition now with respect to b is going to be 1 plus alpha rho over sigma squared minus c prime b is equal to 0. Right? The first order condition with respect to b. Now compare that with when b was observable, the only terms we got was b minus c of b. But when b is unobservable, now suddenly there's an added benefit to b. And it's captured by this term right here, right? This term captures the weight of increasing b by 1 unit on prices. Right? That's the marginal effect of increasing b on the market's price, right? Because it's alpha times rho over sigma square. Alpha is the weight you're putting on prices. Rho over sigma squares is coming from that, right? Your regression coefficient, if you will, this term right here. Now, why is that? What happened now? Suddenly now, when b is unobservable, there's an added benefit to b. Which means that you could now choose a b that is greater than 0 in equilibrium, presumably, because now, before, you were just comparing the marginal benefit to b, which is 1 with its cost, and we, by assumption, that was always less than 0. But suddenly now, if this is sufficiently high, b star could potentially be greater than 0 here. Right? In fact, you could choose a b that is positive, and that b star would be increasing in alpha, rho, and decreasing in sigma squared. So first, why is it that suddenly when b is unobservable, it might be chosen? The reason is as follows. Once the market makes a conjecture about b to be b hat, the firm takes the prices as given. You can see now that given the market's conjecture, the larger the value of x1 is, the market forms the belief that, given the conjecture, the larger the value of x1 is, the market believes pi 2 is going to be high. Right? Because this is positive. Right? The covariance between pi 2 and x1 is greater than 0. This is actually rho. Right? This is rho. So given the market's conjecture, the higher the value of x1, the market believes that pi 2 future cash flow is going to be very high. Now, this in turn implies that the firm is now induced to boost the value of x1 to convey to the market that pi 2 is going to be very high. Because you care about the weight that, in your objective function, you're putting weight alpha on prices. So suddenly now, the insiders of the firm have an incentive to boost P by choosing a higher B. A B they would not have chosen if B were observable. But given that B is unobservable, the market conjectures it, you have an incentive essentially to boost the value of pi 2. Boost belief about pi 2 being very high by essentially boosting x1, right? Choosing a higher B. Right? Choosing a higher B. Because the market forms the right belief that the higher x1 is, it is more likely than pi 2 would be very high. This is because pi B is not observable. The market has formed a conjecture. Given the conjecture, the covariance between x1 and pi 2 is positive. Right? And you can see it's clearly captured here. So the more weight you put on prices now, higher alpha is, the more likely you'll choose a B. B star increases in alpha. B star also increases in rho, because rho means that the persistence between date 1 and date 2 prices is very high, the more you're tempted to boost B. Right? Because it's trying to communicate information about pi 2. X1 is, essentially is highly correlated with pi 2. And also if sigma square is very high, then of course pi 1 is, or x1 is essentially not doing a very good job for you to learn about pi 2. And that's why it's decreasing in sigma squared. Right? So that's the reason suddenly now, when B is unobservable, you're going to choose it. But that reduces economic efficiency. Right? That reduces economic efficiency. Now look at your first order condition, by the way. Remember we said that the market forms a conjecture about B. We have to verify that the conjecture is correct. Well, this first order condition, all the parameters here are common knowledge. Alpha is common knowledge, the market. Rho is, sigma square is. Which means that the market can calculate the B from here. Which means that the conjecture is indeed correct because they know how essentially the structure of the game is and how the game is being played. Which means that we've verified that indeed the market can conjecture it. Right? Because they understand this is the first order condition. Right? So that B hat is going to coincide with the B star, and the B star will be chosen by the manager. In equilibrium then, B hat would equal B star. And of course we're back to essentially maximizing, so E of P tilde given x1 comma B star. Now we can replace the B hat with B star. This is essentially how the market is essentially, this is how, let me write this differently. So in equilibrium, B hat equals B star, and P is equal to E of pi 2 given x1 comma B star. Now I replace the conjecture with the equilibrium choice of the firm. Now of course, the manager essentially is going to calculate E of P given B star, the actual choice. And this essentially collapses to E of pi 2 given B star. And we are back to essentially this kind of objective function here, which is you maximize by choice of B, E of pi 1 tilde plus E of pi 2 tilde plus B star minus C of B star. Except now this B star is greater than 0. Right? Because now there's an added benefit to B. But ex ante, if you fold the problem back all the way to date 0, you're choosing a B that is B star that is greater than 0, that reduces economic efficiency. Right? You should not be taking it, but the reason you're taking it here is because there is information asymmetry between the market, the insiders and the market. The reason for that is when B is unobservable again, the market is forced to form a conjecture. Then once the market is forced to form a conjecture, the manager insiders acquire an incentive to boost their short-term performance via the choice of B in order to convey to the market as pi 2 is going to be very high. But that reduces economic efficiency. Now price is efficient here, but prices are fully efficient because in equilibrium, prices are reflecting fundamentals given all the information of the market. But the decisions are inefficient. B star should be equal to, is not equal to B for full information. It should be equal to 0. You're reducing the expected size of the pie of the firm. Right? You're reducing the expected size of the pie of the firm. If the insiders could come out and credibly communicate B, of course, problem goes away. Right? So the friction again here is that B is unobservable. Right? B is unobservable. Questions? Yes.
Semantic question.
Yeah.
Would you say that's an example of real effects?
That's an example of real effects, yes, because it has essentially the way that you essentially going to be priced in the market, which is P. When B is unobservable, the anticipation of prices would affect the very decision you're making ex ante, right? And of course, you could argue that now this model has no accounting, zero accounting in this model, right? B is observable or unobservable. What we'll do next is essentially we'll put some structure to B, right? Is B intangible? Suppose B is an intangible investment. What kind of information does the market have? How can disclosure or measurement of B alleviate the distortions to B, right? Or to investment in general. But that's, if you will, it has the two assumptions we talked about in the generic model, which is at the date that the firm is being priced, there's information asymmetry between insiders and outsiders. We saw it here very clearly because the market conjectures it to be B hat, which does not coincide with the manager's choice. In equilibrium, it will. But when the manager is solving the problem, you're taking the conjecture as given. Right? So that's the first friction. The second friction is you care about prices. Imagine you're in a world where you maximize actually just pi 2. Right? You didn't care about alpha. In fact, alpha was 0. If alpha was 0 in this model, well, you'll never choose B. It goes back here, right? If alpha is 0, you care about E of x1 plus E of pi 2 minus C of B. Well, E of x1 is E of pi 1 plus B. So you're back to this objective function here. We will never choose B. So as soon as you put any weight on prices and the market is trying to form beliefs about future cash flows, you're trapped in this bad equilibrium. Yeah, you're trapped in this bad equilibrium. Yeah?
So in here, alpha is contract between.
Yeah, so the good point. Alpha here is common knowledge given. The market knows it. You can think of alpha essentially as the market has, that could be, if it's a compensation, you know that the manager is being rewarded based on shares that's going to vest 1 year from now, 2 years from now. So you have a sense of alpha, right? You have a measure of how much market pressure the manager is facing. Rho is also known, sigma square is also known, right? That's important that these parameters here in this model are common knowledge. Without that, of course, the conjecture falls out of the window, right? You will not be able to find. So there's a lot of strong assumptions here, right? There's a lot of strong assumptions here. So again, I view this model as a very good benchmark. The friction here is information asymmetry between insiders and outsiders that essentially leads to the distortion. And the second one, of course, is you care about prices. Yeah.
In the objective function over here, the term alpha rho over sigma 2
Yes.
times
Yeah, sigma squared.
the expectation of pi 1 plus
Yeah. B.
B.
Yeah.
Can you explain why that B is not tilde? Why in the objective function?
It's not, you mean it's not B hat?
Correct, yeah.
It's not the conjecture. That's what you mean, right?
Yeah, why, yeah. Right.
Yeah. So the reason is the following. Remember, the price is, here's the price. Let me rewrite it. Yeah, it's here. So P is essentially, the market is pricing the firm as follows. So P is, where did I write this? E of pi 2 plus rho over sigma squared, x1 minus E of x1. So that's the market. Market is pricing the firm. The insiders of the firm anticipate that's the way they're going to be priced and take this pricing rule as given, and at date 0 they're going to optimize. So from the insider's perspective at date 0, they're going to calculate E of P. Now P itself is a random variable from the perspective of date 0 because x1 is a random variable at date 0. So now I'm going to take the expectation over x1 from the insider's perspective, from the manager's perspective. It will be rho times sigma, this is E of, pi 2, that's fine. Rho over sigma squared, expectation of x1 tilde. But but this is the manager's expectation, right? Given B. This is the market's expectation. Now you know as an insider that X1 is pi 1 plus B, the true choice of B, right? This is the conjecture, this is the true. That's why immediately here I wrote this as E of pi 1 plus B, not B hat. And I didn't write the other terms because they do not depend the actual choice of B. They were fixed, they are conjectures, right? Suddenly now, as a result of this, there's an added benefit to B, and the coefficient on that B is alpha rho over sigma square. And all of that is coming because once the market conjectures, then the manager says, aha, now I have a tool at my disposal to boost future cash flows. I better take this wasteful action, B, to boost X1, and the market sees a high X1 and essentially says, oh, pi 2 is likely going to be very high, right, given the market's conjecture. Of course, in equilibrium, everybody knows what's going on. The market in equilibrium is perfectly undoes it. But you're trapped in that bad equilibrium because, you have essentially, given the market's conjecture, you will boost X1 to boost pi 2. And if you believe the market is essentially unbiasing you at the end, you would still boost it. Because if you don't, you'll be penalized. So everyone is trapped in a bad equilibrium. So sometimes this is called a single jamming equilibrium. You may have heard this. I'm jamming the signal to the market, right? I'm gobbling it, so to speak, to boost X1. Even though in equilibrium, the market knows that they can perfectly undo that B and correct for it. But you're trapped. If you could come out and tell the market, don't do it, but you can't credibly do that, then the market, of course, essentially also is. It's like a prisoner's dilemma game, right? You believe that all firms have an incentive to do it, therefore you also do it. And the market perfectly understands it. But you're trapped in that bad equilibrium. Mario.
With the rho over sigma squared,
Yeah.
it seems that the more volatile the cash flow, the more insulated you are from this problem.
Yeah.
But then, so if you think about research and development, you think, well, that, I'd rather have an R&D than like a more stable cash flow project because I'm more insulated by this problem. Am I interpreting these equations?
Well, yeah. For this type of model here, you're right. I mean, the reason high sigma square here would help you is because it's preventing the market from essentially learning from, right? Learning here is bad because by using learning, you're giving insiders incentive to take this unproductive action.
So like another thing I was thinking is like assume you have a given role. As a shareholder, I would like to increase the volatility of the project so that the market does not make this expectation and you don't get this equilibrium. So is there like a risk-taking implication of this particular?
Yeah, not in this model. So this model is completely devoid of this, right? I think we need to then model volatility seriously. In this model, it's purely learning here. It's purely coming from learning, right? So in a different kind of model, maybe there will be implications like this. You may end up choosing a project. So you're saying that think of a world where every project has its own sigma square, right?
Yeah.
Now, what kind of project would you choose? But again, then there's a trade-off, right? You might still want to choose the project that gives you the higher economic efficiency, but that very project may also have a higher sigma squared. So, right?
Yeah, that's related to the XY example you mentioned, right? You have a project that takes in the long term, but you cannot learn anything from the signal because it's associated with negative. But you have another short-term project which people can learn something, right? That's the same idea, right?
Yeah. It's the same idea. Yeah, it's the same idea. Anything else? All right, so let's, do we need a break or can you guys okay?